Welcome back to my InvestEngine portfolio update now for the month of December. Can't believe this is going to be the final one before we end the calendar year. Now we're going to dive into my account just in a moment, but what a wild ride so far it's been. And it's going to be quite a good one now because we actually have quite a lot of time to look back when I open the account. Now for many regular reviewers, remember that I opened this portfolio and started it in April of 2023 this year. So that means I've had a full kind of calendar year so far to review it. We still have a few more months left as we actually end the tax year. But we've got quite a lot of data now. Now, I will say this before we start, but at the end of 2022 and the very start of 2023, you could not have found many people that would have expected that the market would have rallied so much as it has done now. If you just have a look, for example, at the S&P 500, it's going to finish the year up around 20% or so. Yes, anything can happen in the next couple of weeks, but really, how many people expected that? And the answer is very few. In fact, if you do want to go and have a look and see how many of you actually guessed that, you can go back and have a look at my 2024 prediction video, which I uploaded here. And you can go and see all what I polled and what people actually believe would happen are very, very two different things. Then quickly, if we just broaden things out and have a look at the global perspective, look at something like the FTSE All-World again, that's also up around 10%. Remember, when you look at the S&P 500 and the global market does have all of those US stocks inside of it. And the US makes up around that kind of 60% mark of all the companies and all the value that you can actually invest in. So after the US will come countries like Japan, you have China, you have the UK, etc. And then you have the rest of the countries in Europe and then all of the other developing markets. But in total, you can see that they've also done pretty well. I think at the time of recording this video, up also around 10% year to date. Now, sure, it's been a very, very bumpy year. Remember at the start of the year, we had things like the Silicon Valley Bank going bust, all the issues with bond prices going out of whack, and 2022 actually being one of the worst years for bond pricing. 2023, the sentiment was terrible. Lots of people expected things bad to happen, but really kind of from April onwards, as we had kind of this AI and tech boom again, everything went up, went to the moon. We still had some roller coaster ride as we go, and we still got a bit of time left. But really, it just shows that anything can happen. And just before we dive into the portfolio here on my phone, I think that's a really important lesson to say that, look, every single year, anything can happen in the stock market. And I think the issue you had here at the end of 22, for example, was that you would have had lots and lots of people, probably some of you watching this video, who sold out, you went to cash, you became a lot more pessimistic, you thought, what's the point of investing? And then 2023 happened, and you would have potentially missed out on 20 or even 10% gains if you were a global investor. And now you're thinking, well, that kind of sucks. Maybe next year won't be as good because we've had such a good year. And I think this problem is every single year you can kind of have these thoughts and keep guessing, really, that you're basically trying to time the market if you're going to do that. Over the long run, I just want to capture the returns of the market. Some years are going to be good, some are going to be bad. But if I want the returns of the good years, I also have to put up with the returns of the bad years as well. And if you are a long-term investor with a very long time horizon, we're talking at least kind of 10, 20, 30 years plus, then really you kind of need to trust the process. At least that's in my view. If you're trying to guess and timing the market, trying to think, right, I'll wait next time there's a big crash, or I'll wait next time there is a big dip, that dip may never come. And also when you're buying in that dip, there's no guarantee you're going to get the bottom. And the next thing you'll be worried about is also trying to sell at the top. I really don't get people who are trying to make short-term trades. It just makes absolutely no sense to me. If you need that to keep yourself interested, then fair enough. But the stats show, the history shows that you're going to lose a huge amount of money doing that. And you'll probably convince yourself that you're a good trader and you'll forget about your losses and you'll only talk about your wins. But hey. So anyway, I hope that can be a little bit of a lesson if you are a newer investor that really anything can happen. And it doesn't necessarily matter about what the sentiment is out there. If people are very, very bearish or very, very bullish, it really, anything could happen in the market and no one has this amazing foresight. It's also quite amazing when you look back and see how many people actually predicted this would happen. And the answer was very few, if not almost no one. Okay, let's just dive into the portfolio now and I'll pull this up on my phone and I'll share the screen for you now and have a little look at it. And I think this is really a good example. If I go into my portfolio now to kind of show you as a long-term investor that does just monthly dollar cost average, what things can happen. So on screen now, you can see every time I put this little black dot here, the money's gone into the account at the start of every single month. I've just set my direct debit up. So it's literally just the first of every month. Money will leave my bank account and then get automatically invested into the portfolio here. And as you can see, the green line is then the performance of the market. So because the market has pretty much gone up pretty steadily, you can see here that it has been pretty much green the entire time. And sure, if I had all of this money spare sat in a bank account, really, you should have invested just at the beginning. And I think there's quite a good lesson here actually in talking about one of the big questions that keeps coming up all the time is, if you do have money set aside, is it better to dollar cost average and sort of say you've got £5,000 or £10,000, for example, right now in your bank account, and you wanted to get started investing, Is it better just to put that money in monthly, or is it better just to lump sum? Now, the answer from the data we have and the studies we have, our highly referenced one is this Vanguard one, which I'll try and put up on screen now, which you're welcome to read. But it says, if we do look back through history, about 3/4 of the time, kind of 67% of the time, it's better to do what we call lump sum investing and putting everything you have. Now remember, dollar cost averaging technically is lump sum investing if that is all the money you have. If you get paid in the end of the month, you pay all your bills and you invest what you have left, that is everything you have. So technically that is lump summing, but also it's doing a dollar cost average approach because you are consistently doing it. So a bit of a technicality there, but something that a lot of people miss and don't talk about. But if you did have a large amount of money set to the one side, statistically, at least from the past at least, if we are a long-term investor, it is better just to do it all in at once. However, personally, I think this is very, very much a personal choice for you as an investor, and really it's up to you and your level of risk. Because, for example, let's say the market did have a 20% decline this year, as lots of people expected, you'd probably be saying, well, I missed out on that one. I'm glad I didn't do that in the end. I'm glad I holded all that cash. Really, there's no way to know. But as a long-term investor, I am hopeful that the global economy will move up in one direction, but it's certainly not going to be up in a straight line. It's going to be very much a bumpy ride. Just briefly looking back on the month, we know that November was exceptionally a really, really good month in the stock market. I'll just pull this one up for you now. I think I read that it was the best ever month in a century, for at least for the S&P 500. It just shows how difficult it is to time the market. Who would have thought that this random November in 2023 would be one of the best months in the stock market? But hey. So although that's really interesting to look at, from my perspective, I just put the same money in every single month. And if I can try and max out my ISA this year, that would be great. But we'll see what we can do closer as we end the tax year, how much money I've got, if I can kind of throw some in. Because remember, once you get your money inside an ISA, that money is then set. And then of course, if you don't use your allowance up for that financial year, you do lose it, unfortunately. Just looking at where those gains have come from this month, as you can see, the star of the show is the S&P 500 in total because it makes up a bigger weighting of the portfolio. However, Europe's had a pretty good month actually. And then also, even from a UK perspective, the cheeky little S&P 500 here coming in at over 1.45% gain. The only thing in the red here is emerging markets, which continue to have a pretty bad year so far. But with our contrarian heads on, thinking opposite, does this necessarily mean that they're going to have a bad year next year? Who knows? And if we just expand that out to the maximum length of the portfolio, and I just scroll down here and have a little look for you, you can see that the S&P 500 really has been the star of the show this year. And those big American stocks, the Magnificent Seven, as you may be aware of, kind of your Apple, your Nvidia, your Tesla, your AMD, etc., all your really big tech stocks have done exceptionally well and rallied a lot from the lows that we saw back in 2022 and at the start of this year as well. And yet again, as I said earlier, unfortunately, emerging markets letting us down again. All of this big promised growth will come maybe one day, but at the end of the day, because the weightings are so low inside the portfolio, it really doesn't matter. So losing 2% here, for example, just loses you £22. Losing 2% in an S&P 500 fund when you have 60% of your funds in there would be a bigger amount. But hey, that's the way the world goes. As always, if you are brand new to investing and you do want to get yourself an InvestEngine account like me, you can click on my link in the description below. And actually, when you do set up your account and deposit money, other terms and conditions will apply, but you can get between £10 and £50 as a bonus to help you get started. So don't forget, that's always down there. Now, one final thing I was going to talk about that does get brought up now and then with lots of people in the comment section saying, you know what, with bonds and money market funds, for example, having such good returns at the moment, why would you invest? Why would you get these paltry 6.7% dollar cost average returns when really you could just use a money market fund or even lock up money in a cash ISA? And really the answer to that question is sure. You could lock your money up absolutely in a savings account at the moment with some really, really nice competitive rates in a cash ISA, in a money market fund or whatever, and you could get maybe 5.5%, for example, out there in some of these funds. And these will be extremely low risk, about as good as guaranteed returns as you can get. And you're absolutely right. You put your money in, you know how much you're going to get out. And that is always going to be the competition between doing that and investing where, yes, some years you might get 20% returns, other years you might get 20% losses. The thing with investing, you have to think long term. For those other kinds of investments like money market funds, those are great in the short term if you have to protect cash, for example. But in the long term, if you expand out all the performance of things like stocks and bonds and cash, ultimately stocks will win. But over select different timeframes, really, we never know. And this does come down to what your needs are and what you actually need as someone who's investing. For example, if you're toward the end of your investing career, then absolutely, you wouldn't be 100% in stocks. you do want to be thinking about your own needs and requirements as individuals about what you want to do. So really, as usual, personal finance and investing comes down to your own personal needs. But really, the good thing is now is there is a bit of choice out there for what you can do. You don't have to only invest to get some returns. You can get some returns out there in things like money market funds. In fact, I will share one which I do have set up. I do use this on another platform for some spare cash. Here's just one example. As always, do your own research. I'm not a financial advisor, but CSH2 is available on the InvestEngine platform. Relatively low cost here at 0.07%, and it is an accumulation one. You can put your money into this one, and as you can see, it is a straight line up because it does match those overnight rates that are available to people to be able to get those returns. So you can pretty much put your money in for as long as you want and then pull your money out, and then you'll get whatever returns are available with those overnight rates. Anyway, we'll wrap things up there. Thank you so much for watching. I will leave now my predictions for 2024 up on screen now, which include all of your votes as well. So you might be very interested into what you have to say. Anyway, thanks so much for watching. As always, I'll see you in the next video. As always, happy investing.